Let's get your trading week started. Live from New York City this morning. Good morning, good morning. Your equity market just a little bit softer. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg The Open with Jonathan Ferro.
Live from New York, coming up, Goldman pencils in the first rate cut in 2024. Worries build over China's real estate market, and Tesla begins cutting prices once again. We begin with the big issue, sustaining life above 4%.
This is not the time to panic about duration.
I still think sort of long duration assets are the place to be.
All of these types of sell-offs, that we are seeing in the market.
I think a lot of this bond yield move is technical.
We think of them as opportunities to go long treasury.
We're using duration as a hedge to a growth shock.
We still haven't seen the lagged effects of all this policy tightening.
The lagged impact of Fed tightening.
The Fed is kind of enamored with this soft landing view.
We don't see really any possibility for the Fed to be cutting rates until next year.
The Fed is numbers driven.
Do Fed officials just need to keep policy rates higher for longer?
It is a roller coaster on the data front.
We may have another rate hike. The door's open for a hike in November.
This Fed is not done.
The Fed could screw this up.
Joining us now to discuss is Allsprings' George Bory and Nuveen's Tony Rodriguez. Tony, let's start with this bond market. Yields above 4% on a 10-year at about 4.20. Tony, how much oxygen is left up here?
Well, good morning, Jonathan. Good to be with you. We would say, Nuveen, that there's not a lot of oxygen left. We think that the previous peak that was set in that 4.25 area is really going to be very likely to hold here. So from our perspective, when you get the U.S. 10-year above 4%, that begins to be a very attractive area for investors to begin to take on some longer duration exposure. So whereas we were relatively defensive on duration throughout all of last year, as we moved here into 2023 and we've been hitting that 4% level, that's an area where we begin to like to get our duration back to neutral. We're not expecting an enormous rally from here, but we do think it's an attractive place to earn some attractive income and gain a pretty good hedge against some potentially negative outcomes, because in a negative economic shock, we do think we'll see rates fall pretty aggressively.
George, do you agree?
Well, we would agree that adding, duration in here certainly makes a lot of sense. And we've been sort of steadily doing that, small incremental adds as yields have gone up. The most important thing, Jonathan, is not so much where nominal yields are, but it's where real yields are. And real yields, as we've talked about many times on the program, have moved into in positive territory. And it's time to let the real yield kind of work its magic, so to speak, both from a policy perspective, as it affects the economy, it affects borrowers, it affects economic behavior, but from an investment perspective, when you can lock in anywhere from, say, 100 to as much as 600 basis points in positive real yield, as a bond investor, that's sort of the golden days for bond investing. And that's precisely what we're trying to do today.
Income is back and you're getting more yield over the last couple of weeks. Can we just start with this Treasury sell-off of the last month or so? George, can you walk me through what you think is behind it, this 30 basis point move in the last 3 weeks on a nominal 10-year yield?
Yeah, I think, clearly the data has been good. And there's the hanging question over the market is really inflation. Growth is clearly slowing. There's plenty of headwinds that we think will mount as we move through time because of tighter policy, because of higher rates, because of those higher real yields. But the question is sort of what happens with inflation. It's still an open question. It's clearly decelerating. And the bet is, does it reaccelerate as we get into the end of the year? That's an unknown. And then secondly, the technicals behind the Treasury market in particular have been really weak this summer. As we know, the rating downgrade that came from Fitch, a combination of sort of extra issuance and supply, which is going to continue well into next year, and then international policy, particularly out of Japan, all of which makes for a pretty weak technical backdrop. That's all conspired to push up rates and kind of allow us to retest those highs. we think that's actually a relatively attractive entry point because we think the fundamentals will ultimately dominate as we get through this period of weak technicals.
Tony, for many reasons, you agree. I know based on what you've already told us. You go through the reasons, the yield curve confusion at the BOJ. If you're looking elsewhere, you could point to perhaps the commodity market and the rally in crude. Can we talk about that just a little bit more, Tony? How much of a dominant factor do you think this rally in crude has been over the last few weeks, contributing to what's happened in the bond market?
Well, Jonathan, I think it certainly contributes to the narrative that you're going to begin to see the impact on the consumer, which right now has clearly been very, very resilient from a number of different channels, but higher energy prices is one of those channels. So we can talk about how the excess savings are being worked down. We can talk about how the labor market, while still quite resilient and strong, job growth has decelerated from 400,000 per month last year to 200. When we look at the energy market, that is beginning to reflect itself in the pump price that people are paying. So we think as we look forward, you're going to begin to see some moderation in that very resilient consumer spending strength. And so that's where I think the energy price story is going to play in the most, is on the impact on consumer spending as we move through the year.
A key test for that is retail sales tomorrow morning. Then we'll get a view on the Federal Reserve and FOMC minutes coming up on Wednesday. Lots of retail earnings through the week as well. Let's catch up with Ira Jersey of Bloomberg. Ira, before we get to the rates market, talk to me about the data, what you and the team are looking for from retail sales tomorrow.
Yeah, so we're going to be looking at the control group of retail sales. That tends to be the GDP input. That's slowly been coming down, but it's still reasonably robust. The expectation is for 0.5% for the control group. If we see anything above that, then I think we can retest those yield highs in 10-year yields for sure. And then the minutes, obviously, on Wednesday are going to be incredibly important to the market, just not so much for the high-level data, but for some of the nuance and details. What is the Fed's reaction function if inflation, does continue to ease, but we don't get we don't necessarily get a hard landing. So, what is the Fed's reaction function as to when they'll actually start to cut rates?
Ira, this bond market move is getting tons of attention. I said earlier this morning, you asked 5 different people what the reason is for the sell-off. They'll give you 5 different reasons, and we could pick out a few of them together. Yield curve confusion at the BOJ, additional supply, debt downgrades, commodity rally. For you and the team at the moment, Ira, what do you think is the dominant reason, the dominant factor underpinning this move?
Well, it's not inflation. It's not inflation and inflation expectations. Just look at inflation break-evens. They've hardly moved. It's all been about real yields, and that tells me that it is more of the supply and the monetary policy story. It is all of those things, and it just happened to be occurring during a time when the market is fairly illiquid. You have people going on vacation. You don't have dealers wanting to take a lot of risk, and you still have the market leaning pretty short, which means that you can continue to see the yields edge up toward the cycle highs of last November, but then we can wind up seeing a pretty dramatic pullback as some of these shorts wind up getting covered later. Because remember, with yields as high as they are, it's difficult to be short for a long period of time because your carry is so negative, because you have to pay that 4.2% where the 10-year yield currently is, as opposed to receiving something that on the other side.
Ira Jersey of Bloomberg Intelligence. Ira, thank you, sir. Yields up this morning on a 10-year by 3 basis points, just short of 420. On a 2-year up by 5, 494. 494 on a 2-year. 12 months ago, we were asking Fed officials, what's the biggest risk right now? Doing too little or doing too much? There was a view that doing too little was the biggest risk right now, with inflation perhaps threatening to approach double figures. 12 months later, different story. When you sit here now, George, what's the biggest risk? Backing off too soon or holding too long?
Biggest risk, in our opinion, is over-tightening. We're at the point in the cycle where each incremental move, will have meaningful repercussions. It's the danger zone, if you will, for policymakers. And as we just pointed out, and as my colleague on the show also mentioned, inflation is coming down. We're pointing in the right direction. And so the data, we're maybe getting some false signals regarding how strong the economy is. There are many mounting kind of headwinds, all related to the higher cost of debt, even the consumer starting to show some cracks. So in our opinion, the risk is of over tightening at this point in the cycle, and that they could sort of just sit on hold for an extended period of time, not do much at all, kind of talk the market through. And again, going back to what I said at the beginning, allow these very positive real yields to kind of work their magic. They're not quite as, sort of spectacular as a meaningful rate rise, but they do have a considerable impact on economic behavior as we move through time. That would moderate growth, and that should also bring down inflation at a slow and relatively consistent pattern.
Tony, is that the conversation you expect to see play out in the minutes later this week?
I do. I mean, there's definitely some disagreement on the Fed between the hawks and the doves. But at the end of the day, we do think that policy has gotten to a, we'll call it, equilibrium restrictive level. We think that as we continue to see some moderation inflation, that restrictiveness increases. So those real yields begin to bite harder as we move through the balance of this year. So we do think the risk is that they over tighten if they become too aggressive, because right now we think all of the forces are in play for inflation to continue to moderate, albeit slowly. And we think the growth slowdown will be more obvious to the market and investors as we move into the fourth quarter than what we've seen so far from a growth perspective.
So, Tony, why are people calling for rate cuts to start in June? Bank of America, Mike Gapin, Q2 2024. Then you hear the same from Goldman Sachs, Q2 2024. What is it about that kind of period, the middle of next year?
And I think the key there, Jonathan, is that you really begin to see the impact of those Fed rate increases bite as we move towards the end of this year through the first half of next year. In addition to that, you have the global growth pressures that we're seeing reflected primarily in China, where we don't see those alleviating anytime soon. So as those come together, as we approach the beginning of 2024, that's when the Fed can start to look ahead. And if we're correct that by the end of 24, inflation core PCE should be back below 3%, that'll begin to open the door for the possibility of the Fed beginning to cut rates. We think it'll be late in the second quarter. We think they'll be slow to cut rates, but that they will begin cutting because it's staying at this higher level that is ultimately going to be the key to getting that inflation rate down closer to their target.
George, is that the name on the calendar as well, June? Is that circled for you as well next year for 24?
Yeah. It's a good question, Jonathan. It seems as we've seen over the cycle, the kind of rolling 6-month forecast expecting kind of the sort of material slowdown as well as the rate cuts that come on the back of that. So I think this is sort of conveniently pushing forecasts about a little over, but about 6 months forward, saying sometime in the second quarter of next year, is when we're going to see that. That's not necessarily our view. We think we could be at this kind of extended period, all going back to inflation. If we're allowing inflation to come down organically, that takes a very long time. So we're not committed that it's this magic period of second quarter of next year, but we do expect kind of this ongoing slowdown in activity that just actually allows the Fed to be patient. And I think that is one thing that the market has a hard time with, accepting that the Fed will sit still. One thing that we would disagree with is that once the Fed does start cutting rates, it's likely to be because of something material, and it's unlikely to be sort of a slow, gradual decline in rates. When they cut rates, it's usually because there's a material problem in the system. So that point, I think we would really push back against and suggest if they're cutting rates, they're probably going fast and furious, and they would be taking rates down materially at that point.
George Bory, Tony Rodriguez, the two of you are going to be sticking with us. We need to talk about China in a moment. Bit of tension out there at the moment. Look at China. Downside surprises around economic growth. We're talking about a bond market selling off stateside treasuries. Talked about this a few times this morning. 8-9 years ago, if you woke up to negative news out of China, the bond market would be rallying, crude would be selling off, copper would be underperforming, crude would be down. Waking up today, more negative news out of China, it's the other way around. Last 3 weeks, the last month, the treasury market's been selling off, not rallying, yields are higher, and crude's up. Crude's not down. Crude's up in a big way since the middle of June, up by more than 20%. We'll return to that story in about 5 minutes' time. Let's get you some movers going into the opening bell. That opening bell about 20 minutes away. Here's Abby.
Indeed, John. And one stock that is absolutely soaring in the pre-market, U.S. Steel. It is up more than 30% after it rejected a greater than $7 billion buyout offer from Cleveland-Cliffs. Instead, it's saying it will begin a review of strategic options. Clearly, the company's in play, and actually, it's off those highs. It's now up a mere 25%. Tesla down 2.8%, weighing on futures on the news that they're lowering prices of some EVs in China. And then we have PayPal up about 2.5%. We do have a report from CNBC that PayPal is naming into its Alex Chriss, their new CEO, would replace Dan Schulman. And if you recall, John, in the latest report, operating margins came under pressure. So perhaps this is one fix that investors see. If it is true, again, that's a CNBC report.
Abby, thanks for that. Coming up on this program, mounting risk to China's economic recovery.
China is suffering from a lack of consumer confidence. Very clear. Savings are skyrocketing. We need to see some more constructive policies out of China.
Growing concerns over China's real estate market. That conversation up next.
China is no longer going to be this big factory for the U.S., so that's changed in China. The Chinese consumer is not the American consumer, and that's especially true with the problems that are going in real estate. You've got this internal problem that they've been working on for 2 or 3 years that's failing. Well, you can either keep trying to fix what's not fixable, or you expand.
That was Academy's Peter Cheer. Mounting concerns over China's real estate market with troubles at Country Garden Holdings in focus yet again, seeking to extend a maturing bond for the first time ever and halting trading in local notes. JP Morgan sounded the alarm, writing this: "We see higher risk of contagion, not only across the sector, but also possible spillover to the wider economy." Tom Orlick joins us now for more. Tom, let's talk about this a little bit more. This real estate developer, what's happening there is one thing. What's happening with a wealth manager is another. Is this all about the real estate market in China?
Well, to quote Barbie, Jonathan, some things are happening that could be connected. First, we've got Country Garden, one of the biggest developers in China, and so also one of the biggest developers in the world, on the brink of being unable to service their debts, on the brink of default. Now, at the same time as that, we've got one of China's biggest trust companies. Trust companies in China are shadow banks that take money from rich investors and channel it into high interest rate loans, often to property developers. We've got one of China's biggest trust companies unable to make its investors whole. And of course, these two things are related. As the property sector turns down and big property developers are unable to service their debts, that increasingly is going to mean that financial companies, in this case a trust company, are unable to make whole their investors. If the problem gets more serious, we could see China's small banks unable to make their depositors whole without tapping their capital or getting support from the government.
So, Tom, how ring-fenced do you think this actually is currently, and what kind of risk does it pose to the economic recovery, which has stumbled so far this year?
On the economic recovery, Jonathan, one of the remarkable things about China this year is that even though they face really, really serious problems in the real estate sector, they're still quite likely to hit growth above 5% for the year. Now, of course, the real truth there is that 5% growth is an artifact of the catastrophic growth they had in 2022. It's all strong growth from a low base. But at least in terms of the headline number, 2023 growth is going to be okay. Now, on the bigger question, are China going to be able to ring-fence this problem? Well, so far, there doesn't seem to be much of a desire to ring-fence defaults by real estate developers. Evergrande defaulted, that was big news. Guess what? Country Garden is a much bigger real estate developer than Evergrande was, and so far policymakers do not appear to be running to the rescue. Where would the ring fence come in? Well, my instinct is that the Chinese government has to stop the rot at the banking system. Can some trusts fall over, some shadow banks? Yeah, I think that's probably okay. That can happen without tipping the economy into crisis. Can banks fall over? Probably not. So that is where I would be looking for Beijing to step in with a fix.
Hey, Tom, let's catch up again later this week. Tom Orlick there of Bloomberg Economics on the latest here. George Bory, Tony Rodriguez back with us. Tony, there is what I would describe as some kind of uncomfortable calm around this story in China. We seem to be isolated, disconnected from it, yet we pay attention to it every single day. Tony, what kind of risk does this pose to the US economy?
Well, Jonathan, as you know, the U.S. economy is a relatively closed economy, so it's not going to be a dramatic impact, this quarter, for example. But that weakness, that impact to global growth that'll come from the Chinese economy decelerating from what we do agree is likely to be a 5 handle on growth for this year. We think next year it'll be below 5% and continue to decline over the course of the next few years. That weakness in global growth is going to be part of the narrative that really allows U.S. inflation to continue to moderate as global growth sees that weakness. But the Chinese economy has had these imbalances of being overbuilt and overleveraged in real estate. We think that the government wants to see some of those imbalances reduced, so they're not going to have an aggressive response strictly to the property sector, but they are going to try to maintain, reduce social unrest risks, maintain the stability of the financial system, and have growth moderate slowly below that 5% level over the next few years.
George Bory, final word here.
Yeah, I think the important thing to remember is that, China is no longer kind of the exclusive exporter to the U.S. And that's really sort of what the impact we think is. Countries like our neighbors to the north and neighbors to the south, Canada and Mexico, kind of benefit as China needs to sort of, kind of deal with fiscal policy that's not really working as expected. They can't continue to sort of stimulate like they once could. And the transition to a consumer economy, it's happening, but the Chinese consumer is very different than the U.S. consumer. And so it doesn't sort of unfold in the same way. But kind of the big shift is the demand function. The U.S. is kind of pivoting to other suppliers of goods and services. And, that's why our economy, we think, is holding up reasonably well, while the Chinese continue to kind of work through some of these challenges.
George Bory, Tony Rodriguez. Tony, George, great to catch up with you both. Thank you. I asked this question a little bit earlier on this morning. What's the biggest risk right now for the Fed? Backing off too soon, holding too long. Neil Dutta of Renmac in my inbox just moments ago. I continue to see the primary risk for markets that the Fed takes its feet off the brakes too soon. I'll bring you the fuller quote in just a moment. Coming up, the morning calls, and later, Seema Shah of Principal Asset Management making a case for limited equity upside from current levels. That conversation up shortly. Treasuries down, yields up, dollar stronger, equities struggling just a little bit over the last couple of weeks, including this morning. We fade, equities down by 0.2%. That's the price action. Let's get you some morning calls. First up, Morgan Stanley reiterating Nvidia as their top pick, saying the recent sell-off has created a good entry point ahead of next week's results. Your second call from Bernstein downgrading Marriott to market perform, recommending investors buy shares of Hyatt instead, given the stock's compelling valuation. And finally, Barclays downgrading Mosaic to underweight, seeing limited upside after outperforming the first half of the year. Coming up on this program, a big week ahead for the consumer, retail sales and retail earnings. Seema Shah of Principal Asset Management up next. Your opening bell just around the corner. 2 weeks of losses on the S&P 500, no sign of a bounce. Equity futures down by about 0.2%, fading away from the gains earlier on this morning. For the Nasdaq, really interesting moment. Back-to-back weekly losses on the Nasdaq 100 for the first time this year. If this one closed right here for the month, the Nasdaq 100 down by close to 5% for August so far, it would be the worst month of 2023. From New York, there's your opening bow. Switch on the board and get to the bond market. Over the previous 3 weeks, we've climbed 30 basis points on a 10-year yield. We add some. We add another 3 basis points and approach 420 on a 10-year at 418.55. Getting back to that level getting very close. The post-SVB failure high in the bond market. The cycle high for this cycle, pre-SVB, back to October, about 430. Getting closer, aren't we? Off the back of that yield move, dollar stronger against everything in G10, including the euro. The euro a break of 109. We're negative by 0.6%. On the euro right now, 108.87 against the dollar. And in the commodity market, that's another curious one. A rally of more than 20% from the middle of June. We take some back. We're negative 0.75% at $82 and about 60 cents. About 50 seconds into the session, we're negative here by 0.2% on the S&P. On the Nasdaq, we're down by about 0.4. One stock to watch at the open is US Steel. Shares surging after rejecting a $7.3 billion takeover bid from rival steelmaker Cleveland-Cliffs. US Steel calling the offer, quote, unreasonable, despite representing a 43% premium to Friday's closing price. Abby has more. Hey, Abby.
Hey, John. And this has the stock on pace for its best day ever, going back more than 3 decades since it was first a publicly traded company back in 1991, up 25%. So clearly the company and the stock are in play. The fact that they rejected that unsolicited $7.3 billion bid from Cleveland-Cliffs suggests that perhaps they think, and also that language you were just talking about, unreasonable, suggests that maybe they think that they can get more. Apparently there are other offers on the table. The board acknowledged the receipt of a number of those offers for parts or all of the company. So it's very unclear what strategic alternative they will in fact pursue. But one thing is clear. This was a $200 stock back in June of 2008. In the depths of the pandemic, it was a $4.54 stock, as in $4.54. So down tremendously. The board and investors are probably looking to unlock value right now at roughly $29. It's close to the highs over the last decade or so, John. But again, investors probably wanting to unlock more from U.S. Steel, and the fact that there are suitors out there suggests that they will be successful in doing so perhaps this year.
Abby, thank you. That stock is up by more than 26%. Here's another one for you. AMC wins court approval of a stock conversion plan, clearing the way for its recapitalization efforts as it faces possible bankruptcy. Simone Foxman has the story. Hey, Simone.
Hey, John. Yeah, the shares down the most in well over 2 years after a judge approving the settlement that it had reached with shareholders after the bell on Friday. This stock conversion plan, they want to increase the number of shares. It contemplates also, it says that the company will also convert those private equity units into common shares as of later this month. The whole idea is to shore up capital reserves, pay down debt, and invest in growth plans. Judge Morgan Zern, in Delaware Chancery Court, approving that plan late Friday. There were some concerns that this would dilute the shares of common equity holders, but she found that giving them additional shares mitigates these concerns. We are seeing the impact of the dilution of these stocks, however, in the market this morning. These private equity units, preferred equity units, catching up, narrowing the distance between those common shares. They are rising today.
Simone, thank you. AMC, they're down by 34%. I want to draw your attention to this one. Hawaiian Electric Industries plunging at the open here in U.S. trading off the back of some concern that its power lines may be linked to the deadly Maui wildfires that we've all witnessed over the last week or so. That stock is getting absolutely hammered at the open. One to watch through today on Bloomberg TV and on Bloomberg Radio. Let's turn to the auto sector. Tesla rolling out a new round of price cuts in China, according to a post on its Weibo account, reigniting fears of a price war following similar moves by a host of automakers in Asia just last week. Ed Ludlow has more. Morning, Ed.
Good morning, Jonathan. Tesla is down more than 3% at the open. The trim in China is $1,900 to the Model Y long range and performance. That equates to a 4.5% trim on the long range and a 3.8% trim on the performance. And as you and I have discussed on this program, using the lever of price cuts has been normal for Tesla in the first half of 2023. The concern, though, is twofold. As you point out, a note from Evercore and Chris McNally saying that this could presage cuts in other regions, like in the United States and Europe, and in turn lead to a price war for EV players globally. You look at the market reaction in China, names like BYD, falling, Li Auto, XPeng, all seeing their Hong Kong or China-listed shares impacted overnight. Here in the US, other pure play names like Rivian and Lucid are also lower at the open. The second concern that analysts will have is Tesla's bottom line and the impact of further price cuts on gross margins. Remember, when the mix of Tesla's deliveries is skewed towards domestic China deliveries, it has been supportive of margins in the past. But Elon Musk and Tesla's position has been very clear. They're willing to sacrifice the bottom line, use price cuts as a lever to open pockets of demand at lower price points in order to protect that target growth rate of 50% annual growth year on year. It's a common piece of Tesla's playbook, Jonathan.
Volume over margins, he's talked about it continuously. Ed, just briefly, is this more about the global EV market, or is there something specific about China and some of the weakness there for that industry?
You know, we talk about this so often about how in China there are many more domestic players offering a much wider range of pure battery electric options to consumers. It is a more competitive market. The 3.8% trim on the performance or 4.5% on the Tesla Y long range is in line with prior cuts. It's not a severely deep cut to prices. And indeed, if you look at the cuts of the first half of the year, some of them have been much deeper, higher single digits or even double-digit cuts here in the United States. So that bear that sort of uniqueness of the China market in mind.
Ed, thank you, sir. Let's stick with EVs. We can do that this morning with Nikola announcing plans to recall over 200 trucks and temporarily stop sales after several battery fires. The CEO stating, at Nikola, we take safety very seriously and will continue our transparency as we learn more. Katie has the story. Hey, Katie.
Hey, John. Yeah, to get specific here, the EV maker is calling back about 209 of its Tre trucks. That's after a third-party investigator found that a coolant leak was the likely culprit behind a fire at Nikola's Phoenix headquarters back in June. And in addition to that recall, like you mentioned, Nikola is also going to temporarily pause its sales. It did say that its vehicles can remain in operation, but it advised its customers and dealers to park outside until a fix is ready. I don't know if that's reassuring. You can see the shares currently off by about 12%, and today's plunge follows a pretty stellar run for the shares. Actually, if you look at the past 3 months into Friday's close, Nikola shares were higher by about 154%. But zooming out for the context, Nikola is down over 80% from its 2020 IPO, John.
Katie, thanks for that. About 8 minutes into the session at the moment, equities are lower. No drama here. We're down by 0.2% on the S&P. On the Nasdaq, we're down by 0.3. For those of you who like round numbers, very, very close to 420 on a 10-year. The higher the session is right now at 419.92. We're getting closer and closer. There is a sell-off in the bond market. There's been one over the last month, over the last 3 weeks. A 30 basis point move on a 10-year. Yields are up today on that maturity by 5 basis points to just short of 420. On a 2-year, up 6 basis points there to 495. Yields just pushing higher over the last month or so. Seema Shah of Principal Asset Management recommending investors stay flexible given the changing macro environment. She writes this: as the economic slowdown moves closer, our positioning will be adjusted to take advantage of the emerging opportunities. We shift equities from slight underweight to neutral, given a US recession, and any equity pullback will likely be short and shallow. The following recovery will likely be swift, requiring a nimble and active response from investors. Seema, I'm pleased to say, joins us now. Seema, I want to begin in the bond market. 420 on a 10-year on my screen right now. We're through that level. On a 2-year, we're up 6 basis points to about 495, 496. Seema, what's behind this move in the bond market over the last month?
You want me to give you one of the 5 different answers you've already had?
Please do.
Well, look, from our perspective, it's really these. I guess the key thing is about expectations for a soft landing. And with that, there's rising hopes that maybe, or rising concerns, in fact, that inflation could end up being stickier, leading to maybe further Fed hikes down the line. So not talking about in the immediate future, but further down the line that maybe the Fed loses control of the inflation fight. And I've got to say, I do not buy into that. I think that we're going to see a drop in yields as you get closer to an economic slowdown. I think the inflation story will be, maybe it's not going to go back down to 2%, but it will be contained. So I think that this is actually an opportunity to add duration, rather than being too concerned where exactly this is going to go.
So at the 10-year, at the 30-year, how long along the curve are you going to go, Seema?
So I think you can look a little bit at the belly, but further out as well. So really on the 10-year point, I wouldn't be looking at the short end for right now. We are expecting rate cuts in 2024, not this year, so that's a little bit further out. So it's really at that 30 and 10-year point that we'll be adding duration.
Seema, this has been happening with a rally in the commodity market in the background as well. One question we've got coming into this week is just on retail, on earnings there. How resilient is the consumer against the backdrop of commodities starting to increase again and rates still at pretty elevated levels?
So look, they're clearly resilient today, but that doesn't mean that they're going to stay resilient going forward. So we do think the headwinds are starting to build up. You've obviously got the excess savings, which I know has been a narrative for a while, but it is now starting to come through, where the excess savings is starting to be exhausted. And by the end of this year, we do think the consumers will be having to dip into credit cards and really to pull back on spending. The other part of this is, of course, the student loans. And then, as you said, inflation, food prices, oil prices, all of these things are going to be cutting into consumer spending. It has taken a while. I would argue, I know that from other people that they believe that the lags have been very short. I would argue that the lags have actually been extra long this time. And one of the reasons is this huge amount of excess savings that has helped cushion consumers and actually to some extent corporates as well.
With that in mind, Seema, when we hear from the likes of Target, Walmart later this week, Wednesday, Thursday respectively, do you expect to hear more about trading down and less about pricing power?
I do. I think pricing power is really becoming an increasing issue. And in fact, when you start to think about how to invest, it's not necessarily about sectors or styles or anything like that. It's really about focusing on which companies do have that pricing power. As inflation continues to come down, as you get an economic slowdown, which of the companies are going to be able to withstand those kind of economic pressures? So yes, I do believe that that's going to be an increasing narrative going forward, not just this, of course, earnings season, but the next one's coming up.
So I take it you wouldn't be a buyer of this story of the equity market continuing to broaden out and to buy this cyclical play, not just in bonds, but also in stocks?
I don't buy into it. Look, I think that there is a lot of very positive investor sentiment. The soft landing has really become the consensus view. So there is going to be some broadening out. Now, how long that can be sustained, I think, is very questionable. Because, as I said, we are expecting the economic downward forces to start kicking in through Q4. Whether you want to call that recession or a slowdown, I think it's somewhere in the middle of that balance. But that will mean that things like small cap will be challenged. Now, for us, I have to say, once you start to see those challenges and once you start to see the labour market start to unwind a little bit, then that will be the best opportunity to increase your exposure to things like small cap. I don't think this is the right timing, but there will be opportunities in the coming quarter or next 2 quarters where you can start to put a lot of that money to work.
Russell down today by 0.8%. Seema, I promised a fuller quote from Neil Dutta of Renmac earlier on in the programme. I want to share it with you because it's almost a counterpoint to the kind of things that we're talking about currently. He says, I continue to see the primary risk for markets is the Fed takes its feet off the brakes too soon. You either believe a period of below potential growth is necessary to quell inflation or you don't. He says, given the inflation tailwinds from housing, motor vehicle, airplane assemblies, inventories and consumption, the US economy is nowhere near a below potential growth situation. He goes on to say and finishes with this line, the Fed continues to breathe life into the idea that rates might be cut early next year. Not good. Seema, what would you say back to that?
God, I have a huge amount of respect for Neil and he makes some really strong points. We're somewhere in the middle there actually, but what we're saying is that although the economy is resilient today, it's going to slow down. And we do buy into the idea that you need to have an economic slowdown if you're going to take out the firepower behind inflation today. But we think that's going to come down slightly down the line. So for us, the Fed stays on hold right now. You do start to see rate cuts coming through in Q1 of next year, late Q1, as some of those recessionary fears start to actually come to fruition. But I do buy into a lot of what he's saying, that look, the economy is very strong. The Fed does need to keep very, very aware and on top of that data. But to us, that means keeping rates on hold where they are rather than raising them further.
Seema, thank you for the update. Seema Shah of Principal Asset Management. Her views on the equity market, how they contrast with the likes of Neil Dutta and others, just subtle nuances. About 14 minutes into the session, let's go cross-asset together. Equities down just a touch. In a bond market, much more interesting moves. Treasuries down hard. Yields up 6 basis points on a 2-year, 4.96. 10-year, in and around 4.20 right now at 5 basis points. So yields higher. Push that through the FX market. Dollar, a whole lot stronger. Euro dollar, negative by 0.6%. Session lows, break of 109, 108.82. Coming up, also about a week away, debates for presidential candidates. They're taking a swipe at Bidenomics.
Bidenomics is a failure, despite all the happy talk coming out of Washington, D.C. You can tell there's an election coming up because all of a sudden Democrats at the White House are telling you how their policies are all working. But we have a national debt the size of our nation's economy.
That conversation up next.
Bidenomics is a failure, despite all the happy talk coming out of Washington, D.C.
I define Bidenomics as the poor get poorer.
When I take a look at the Biden administration and where they're headed in the wrong direction, I don't just mean course correction, I mean a 180-degree turn.
Republican presidential candidates taking a swipe at, guess what, Bidenomics. The president leading an administration-wide effort to celebrate the one-year anniversary of the Inflation Reduction Act, traveling to Wisconsin Tuesday and hosting an event at the White House on Wednesday. Vice President Kamala Harris highlighting the IRA's clean energy tax credits in Seattle, while Secretary Yellen delivers remarks from Las Vegas later today. Writing in comments released on Friday, workers are better off than they were last year. Real average hourly earnings have grown over the past 12 months, meaning that wage gains are outpacing inflation. Let's get you some team coverage. Katie Lyons and Mario Parker. Mario, that's what they're selling. Is the electorate buying it?
No, not right now, Jonathan. The electorate is not buying it, even though Biden is touting it and, as of right now, pinning his White House reelection strategy on the economy. Voters give him poor marks on it. And that, as you mentioned in the segment prior to this one, this is why you see Republicans attacking him for it on the campaign trail.
Kaylee, why is it falling on deaf ears?
Well, this is the question, John. I spoke with Cliff Young, the president of U.S. Public Affairs over at Ipsos, which is a polling firm, and he essentially said price pressures may be easing in terms of the extent to which prices are going up, but Americans are still feeling pinched in their pocketbooks, and as a result, they're feeling surly about the economy. So as the Biden administration is touting how great things are, people aren't necessarily feeling great in reality, which may be why there is this disconnect between what we are seeing in economic data and what American people are suggesting they feel about this administration. Hence this 10-state tour that the president and his surrogates are embarking on, really trying to double down on the messaging that they have been good stewards of the economy through legislation like the Inflation Reduction Act. And we have to consider what states they are traveling to here as well. Janet Yellen, for example, speaking late this afternoon from Las Vegas, Nevada has the highest unemployment rate in the country, 5.4%. But at the same time, as you read there, her talking about wage gains outpacing inflation in leisure and hospitality, which is huge in Las Vegas. That is where some of the wage gains have been the strongest. So perhaps that's why she's doubling down on that messaging there. And we also expect her to say, according to her prepared remarks, that she does believe there is a path to continuing to reduce inflation while maintaining a healthy labor market. John.
Mario, we heard there from Republican candidates. We've heard there from Kaylee what we're likely to hear from the Treasury Secretary. I think we know what we're going to hear from Republican candidates on this issue as well on the debate stage next week. Mario, what we don't know is who will be on that debate stage. And one man in particular hasn't really shown his hand. Mario, is the former president going to show up or not? And how close to the event do we need to know by?
Well, he has to let the RNC, the Republican National Committee, know within 48 hours. We're talking about, of course, we're alluding to one Donald J. Trump, the former president, who is also a former reality star. So he's trying to keep us on the edge of our seats as to whether or not he's going to show up, right? Polls show, to Kaylee's point, polls show that he has a wide lead over the rest of the field right now. So it may not make sense strategically for him to show up at the debate. From what I understand from sources within Trump world, it's 99% certain that he will not debate. They're holding out that 1%. Now, that 1% is loaded because we're thinking about that ego that Trump has and whether or not he wants to cede the stage to some of his competitors and essentially cede the spotlight as well.
That's an important 1%. Mario, thank you, sir. Alongside Katie Lyons, to the two of you, thank you. The team coverage down in Washington. Let's return to the markets about 22 minutes into the session. Equities just a touch lower with some sector price action. Here's Abby.
And relative to those sectors with the S&P 500 down ever so slightly, we have more sectors lower, but mainly small moves to the upside and downside. The worst sector on the day, utilities, down. Actually, it's a greater decline at this point, down 0.9%. That's actually, in a way, risk on, only because that's a defensive sector that is suffering because of yields being higher. On top, we do have two of the mega cap tech tech sectors. Tech and communication services both up less than 0.5%. Over the last month, though, John, it's really interesting because utilities, this is one of the worst sectors, but so too is technology and consumer discretionary. So we really have this picture as the 2-year yield has backed up by 20 bips and the 10-year yield by 40 bips. Sectors getting hit on all sides, both safety and offense.
Abby, thank you. Your trading diary up next. At 25 minutes into the session, early days, but small caps getting hammered at the moment. The Nasdaq just about positive, and the S&P down by about 0.1%. That's the price action. Here's the trading diary. Coming up 5 p.m. today, Yellen, the Treasury Secretary, discussing the Inflation Reduction Act in Las Vegas, Nevada. U.S. retail sales coming on Tuesday, plus some Fed speak in the mix as well. Target reporting results before the opening bell on Wednesday, plus the Fed minutes coming on 2 p.m. on Wednesday too. Followed by Walmart earnings on Thursday, along with another round of initial jobless claims. From New York City, looking forward to covering the week with you all. Get my words out. This was the countdown to the open. This is Bloomberg.